Hey guys, John Polemy here, Actionable Intelligence Alert. Today is Saturday, November 9th, 2019, and this is the weekly market update. Before we get into the update, just wanted to remind listeners that I do have a Patreon account. I will put a link to it in the show notes. And if you are, inclined to support the work that we do here, you can go to Patreon and become a Patreon and support us via that website. You can cancel at any time. As a way of rewarding you or incentivizing you to do that, I will give you the current month's newsletters stock pick that we are involved in. So just wanted to have that shout out to people. I know some people write me sometimes, say, how can I support you? If you don't want to support me monetarily via Patreon or via subscription to the newsletter, hitting the like button, subscribing to the channel helps us get traction with YouTube and increases our viewership and gets the message out to more and more people. But I definitely do thank guys for the support. You guys share a lot in the comment section. I get a lot of good emails from people. I'm just one man here trying to, with an opinion, trying to get it out. I know some people, I don't expect everybody to agree with me. I don't propose that I know the answer to everything. But what I am trying to do is get this knowledge out there and give my views. And I'm happy to be corrected. I'm happy to consider other views. And that's kind of what the whole basis of this is. So, and obviously as a way to promote my newsletter and my other activities. So just wanted to touch on that before we get into the update. So this week's reality check, several articles out this week, something that we've kind of been talking about anyways for several months, and it's creeping more and more into the mainstream, and that is that, the struggle that U.S. shale is now in, and is the boom over? Of course, I think the boom is over, and I think that that's being echoed by several high-profile executives in the shale industry. For example, Chief Executive Pioneer Natural Resources, Scott Sheffield, said that this is from the recent earnings report conference call that Pioneer Natural Resources had. And I think it makes good sense to listen to this because Pioneer Natural Resources is one of the darlings, one of the stars of the shale business, especially in the Permian. And what did the CEO say? So that the Permian Basin is going to slow down significantly over the next several years. Not that it's going to grow, not that it's going to be the next Saudi Arabia, not that we're going to go to 25 million barrels a day, that it's going to slow down significantly over the next several years. And that's not some crackpot or somebody that doesn't know what they're talking about. This is the CEO of one of the major companies that's in the Permian Shale Basin. He goes on to say, I've lowered my targets and my annual targets. A lot of it has to do with, to start with, the free cash flow model that public independents are adopting. Yes, because there has been no free cash flow. That's the problem. We've pointed that out since this video series, since I started these videos. The large majority of these companies, forget about profits, don't even have positive cash flow. They've been subsisting on, so it goes back to really the whole boom bust follows the same trajectory of every other bubble. This is like if I want to go to a public event and sell bottled water that I buy for $1 a bottle and sell it for 75 cents. I'm going to sell a lot of bottled water, but I'm not going to make any money. But then what do? I put a business case together that the volumes that I'm going to increase my volumes. And at some point, after I capture all this market share, then I'll get profitable. That's been the whole business model of every bubble that we've ever seen in a stock market. And this shale bubble is just another one. And it was fueled by debt. People were, with these low interest rates, there's no where to go for any decent interest rates. So people have plowed into financing these shale companies via junk bonds. They've subsisted on that equity issuance with the same with the same view. We're just going to drill all these wells, and as we get to a certain threshold in our drilling and completions, we will turn profitable and be cash flow positive. Well, it's not happening for most of them. Now, some of them are, but not all of them. And now the funding's drying up because shareholders, you can look at the stock prices, you can go look at the charts and the stock prices of many of these companies. They're down 50, 60, 70, 80%. Bankruptcies are increasing. Layoffs are happening out there in these oil patches. And that's not indicative of a growing, healthy industry. I mean, I thought this next statement was the most enlightening one I've heard since this thing began. He said, I don't think OPEC has to worry that much about U.S. shale growth long term. Well, we've been saying that for a couple of years. Now, the consensus is among many analysts, especially even in the oil industry like Rystad, that U.S. shale production is going to keep growing. Now, it is still growing, but the rate of growth is slowing down massively. And this isn't just Scott Sheffield at Pioneer Natural Resources saying this. Mark Pappas, former chief executive at EOG, another one of the shale darlings, has said the same thing. And he said a lot of it wasn't just because of the financing and the demand of shareholders to want a return. A lot of this is coming also from the fact that they're running out of the choice drilling locations, the tier one, if you will, drilling locations. And I will get into that later in this video when Goehring Rozencwajg came out with another great report about that exact subject. So this news came out this week also. Oil rigs have seen a loss of 202 rigs year on year, with gas rigs down 65 since this time last year. And this is just on North America, Canada, and the U.S. By state, Texas has seen a drop of 119 rigs year on year, while Oklahoma sunk by 97 to hit 57 rigs. If the shale industry is growing, if the shale industry is going to take over the world, if that's where all the new oil production is going to come from, why do we see this huge drop in rigs? How come we're not expanding rigs? How come we're not booming? The boom's over. Now we're going to get the echo boom and the bankruptcies and the debt that's going to get puked up. This is what I've been talking about. The lack of investment in conventional oil production happened because of lower cash flows due to a collapse in the oil price. The collapse in the oil price came from this bubble, this false boom in this shale. So now you've had this gap of years now where there's been no conventional oil finding or production or bringing online because shale has pretty much sucked all the oxygen out of the room. It has accounted for most of the growth of production, while other facets of oil production, i.e. offshore, have been strangled in the crib. There's been no incentive to drill offshore and have long-term projects with risk. And then you couple upon that the whole political zeitgeist is against hydrocarbon companies. We'll get into that later in the video. And there's just a plethora of things, shareholders demanding return on capital, dividends and buybacks from the majors and not investing. And this is going to create a supply shortage down the line. And like I said here, stakeholders are demanding returns and sources of funding are drying up. I mean, this is a Red Queen's race. The first year, we've talked about this many times, the first year production on a shale well declines by 70%. The next year, you're down another 50%. And then the third year, down another 30%. So if you had say you had a 1,000 barrel a day well, I mean, you're down to 300 barrels by the end of the year, the first year. Then you're down to 150 barrels the next year, and then you're down to 100 barrels the next year. So you have a 90% collapse in production in the first 3 years. So that's what I'm talking about, a Red Queen's race. You have to drill more and more wells just to make up for that decline, and then not even to mention if you want to increase production. And so now the cash flows aren't there, the funding's dried up, the boom is over. We've seen this before. Housing bubble, internet bubble, cannabis bubble, Bitcoin bubble. That's all this was a bubble. It wasn't a sustainable industry. Now, some of the locations, some of the companies are doing well or can make money at these oil prices, but most of them can't. And the oil company executives are not in the business. Well, they are now because they're forced to, but before they had unlimited capital available to them, and that's dried up. So if you give an oil company executive money to drill, what do you think he's going to He's going to drill because he's probably incentivized to do that. So this is playing into my thesis that we are going to have substantially higher oil prices in the not too distant future. And the lack of investment has shriveled up the industry's ability to go out and find new reserves and produce them. We've had many bankruptcies in the oil service industry. They're down on their backs, although the industry is turning around slowly but surely. But I think that the amount of investment that's going to be needed to find new oil is not going to be able to find a place to go. And that's what I think the opportunity exists in oil field services and especially offshore. I want to talk about the Goehring and Rozencwajg had a good in their third quarter report. Again, I've talked about this before. It's about a 25, every quarter they do about a 25 to 30 page review of the different resource markets. They've done a lot of work on the shale industry. They've used a lot of AI, and they've went company by company, field by field. They've been using AI and some supercomputing power to really figure out what's going on. And I'm not just bringing them up because I have a bias to a certain idea, but this is where I get some of my ideas. The data is where it's at, and the explanation makes sense. So I'll put a link to this, but I just want to go over what they said here. What's happening to U.S. shale production? After growing by a torrid 145,000 barrels per day per month in 2018, shale production growth has ground to a screeching near halt. Since December, that's of this year, or last year, shale oil production has grown by only 50,000 barrels per day per month. So it's still growing, but it's decelerating the growth. And I just pointed out why. If you have rigs, more and more rigs not working, and the rig count collapses, of course you're going to have a decrease. And why is it collapsing? Because you can't make any money and there's no financing anymore. You have a 65% decline in growth versus 2018's phenomenal rates. Conventional wisdom held that productivity gains were the result of operators drilling and completing larger and better wells, longer laterals, larger proppant loadings, and greater fluid volumes. However, we believe the surge in drilling productivity over the last 5 years is less the result of how producers drilled their wells and more the result of where they drilled them. In particular, we believe the improved drilling productivity was the result of a practice known as high grading. And high grading is not a new concept or something that is just endemic or specific to the oil industry. It is typical in mining, especially if prices are down. And what companies will do is they will have a resource, they will map out their resource, and it's basically the low-hanging fruit. So the low-hanging fruit, and this is exactly what the CEO of EOG, Mark Pappas, has been talking about over 2 years ago, that has been the entire business model of the shale industry. They have drilled out the prime locations, and that's what you would do because they are the cheaper to drill and they are the most productive. So you can get a higher return on them. So that makes logical sense, but you have a limited amount of those and those are gone. So now it's like walking up to an apple tree. You can pick a lot of low-hanging fruit and it's not very exertive. Now, if you want to get to the higher fruit, you have to go get a ladder. You have to go put it up in the tree. You have to climb up there. You have to get scratched up by the branches. It becomes more difficult. You can still get you can still get apples, but it becomes more difficult, time-consuming. So I will put a link to this. I suggest you read it. In their third quarter, you have to sign up, of course, but they don't bother you with emails or anything. They'll just send it to you. I would get on their mailing list anyways. I would be reading what these guys had to say. They're very smart people. So Basso Analytics, who we use to follow the offshore drilling industry, November 4th, they came up with a Jackup report for Jackup rigs. And what do they have to say? Higher day rates and long-term contracts roll in for another good month in the Jackup market. Mexico, the North Sea, West Africa, Southeast Asia, and the Middle East have all experienced reduced availability of rigs and increasingly active tendering environments. Day rates are rising for premium rigs and are now firmly in the $80,000 to $100,000 per day range for 2020 work, with some going much higher, like the contract for Noble Regina Allen at $120,000 a day in Trinidad. So this is what we've been talking about. You use a jackup rig in shallower water. It's cheaper to drill in shallower water. You can turn your investment around quicker. So that's why we're seeing the recovery. As these oil companies need to replace their reserves, they will go out deeper and deeper. As the shale industry slows down and the market comes more into balance and goes into deficit, which it will, the lack of investment will make itself known, and they will be forced to go out deeper water, and that's when the floaters and drill ships will begin recovering. It's a process. It won't happen in the next 3 to 6 months. It's a multi-year process, but it will happen. We will see oil prices over $100 a barrel again. I don't know the exact timing, but don't people find it instructive that the oil price has kind of been improving over the last several weeks? It's not collapsing. Where's this economic collapse? Just before I got on this call or this video, I looked up again interest rate cuts. There's been, a whole ton, like 70 interest rate cuts by central banks around the world the last 2 quarters, quarters 2 and 3 of this year. 70 central banks around the world have cut rates. Why? To stimulate their economies. I showed last week that the worldwide leading economic indicators are starting to turn. Leading economic indicators. By the time, we're starting to see, if you put enough, like I said, if you put enough money out there, you can force an economy to grow. Okay, you can force the economy. Now you will have, that will trickle down into commodity pricing and energy pricing. That's what I think we're seeing. We're at 100 million barrels a day of demand. That's not going to go away. It's growing, and the investment just hasn't happened. And we're seeing this continued recovery. I mean, these are the people that track it. That's what they do all day, and that's what's happening. It's just happening just like we thought it would happen. So I continue to remain very positive. That's probably one of the most bombed out sectors out there is offshore drilling and offshore oil services. And you see the same thing. If you go look at, for example, back down the food chain, if you look at like companies that perform seismic services offshore. I mean, that's the first thing you need to do, right? If you have a prospect, you need to go out there and do your seismic work and try to identify drilling locations. Well, those companies are recovering very nicely. Their contract backlog is increasing. So the pig is working its way down the python towards the drilling and completion people and our offshore drillers, and we're starting to see it. And I believe that it will continue. Again, wanted to talk about, reserves continue to shrink at many oil majors. Basically, the oil companies, it's not a fixed rule, but they try to maintain at least what they 10 years of reserves based on their current production. And as you can see, as oil prices were very high during this time, you see that they kind of maxed out their reserve life indexes. A lot of them were increasing back when oil was, $100 a barrel. And then as it rolled over and the investment dried up, many of them have been in decline. Look at Shell. Shell oil is one of the lowest. They're almost at 8 years. That's not good. And what do we mean by reserve life indexes and reserve life replacement? Well, these are extractive industries. If you don't replace what you're producing, you will go out of business at some point. And this is going to get particularly more and more tenuous. This is a thing I'm going to go into here after this slide. It's becoming more tenuous because a lot of obstacles that these oil companies are running up against. And that's another thing that I think is going to exacerbate the price rise in oil and contribute to us making a very large sum of money over the next several years. Now, capitalist exploits Chris McIntosh's shop. There's an article they wrote, I don't know, it was a couple weeks ago or a couple months ago, but I was reminded of it when I saw this other article about various oil companies being sued by left-leaning cities and states. This particular quote here is from an article off one of the left-leaning climate sites. It says, over the past few years, 2 states launched fraud investigations into Exxon over climate change, and one is followed with a lawsuit that went to trial in October 2019. 9 cities and counties from New York to San Francisco have sued major fossil fuel companies seeking compensation for climate change damages, and determined children have filed lawsuits against the federal government and various state governments, claiming the governments have an obligation to safeguard the environment. I also wanted to throw in here that the person that right now is one of the front runners for the Democratic nomination, Elizabeth Warren, said one of the first things she's going to do when she gets into power is ban fracking. What I'm trying to tell you is that I will put the link to the article, which I think you should read, is that this is the same kind of language we heard when politicians were attacking the tobacco companies about 10 or 15 years ago. And the tobacco companies had to pay billions and billions of dollars in compensation and fines and agree to do different things. And people said, well, that's the end of that industry. Who would ever invest in that industry? Who could ever make money in that industry? And what you will see when you read the article, which I suggest you do because the similarities are very, very clear and are kind of the same, if you will, although smoking tobacco products is not really a necessity. Having hydrocarbons are for modern society. But a lot of the similarities around the attacks are the same. And what you will see is that tobacco stocks crush the returns versus the S&P 500. And the article goes into why that is. So my view is that I kind of chuckle at this. The West is, self-immolating itself with this nonsense, and that's fine. I mean, I'm not here to say yay or nay. I don't really care at this point. I'm a world citizen. I can get up and move somewhere else. I have a bolt hole in another country. That's not insane. If the West wants to get rid of hydrocarbons, which they can't, and they want to sue these companies and make it, all this does is make it harder and harder to produce the required hydrocarbons that we need for civilization. And that will force the price up. That's all that will do. If they want to put a carbon tax on things, if they want to sue these companies, if these companies want to settle, I mean, these oil companies are not going to fight back. They're going to try to mitigate the damage because they see the zeitgeist. If you're the CEO of Exxon, you're going to fight litigation, but you're also going to do some greenwashing. That's what BP does. They have all these wind farms and everything. You're going to try to, walk a fine line. And then in the end, if you have to pay out some money, fine. But, who actually pays? It's the consumer of the products. And that's the same thing that happened with the tobacco industry. I mean, smoking's in decline. It's a hated industry. Everybody's against smoking, and yet the companies continue to kick out cash flows and returns that crush the S&P averages. So I think it's something to pay attention to. It's not something to get nervous about. And the thing about it is it's just you're not going to be able to get away from these from oil and gas. It's just you can't do it. Not if you want to maintain the civilization. And I hear people say, well, we're going to replace with electric vehicles. I mean, you just don't know where you're going to get all the base metals, the materials. People just don't take it. You just can't make comments like that. Well, we're just going to replace everything. Well, then these people don't know like concepts like Javon's paradox. When you have technological change or you get increasingly efficient, you get more demand for energy, not less. If you really wanted to do something about this, and if you're really serious about it, you really have to get serious. People can't live in suburbs. People can't commute in vehicles. You have to change people need to live in, like they do in a lot of European cities, in tight clusters, smaller homes, public transportation. You really have to dial things back. And you're seeing the riots around the world. These governments that are trying to push this agenda in France have been over a year of yellow vest protests for like 54 weeks now and doesn't get reported. You see there's 1 million people in the street in Chile over a subway increase because of the insistence of the government to try to go to green energy. You see what happens in Germany, okay? They spent $500 billion on renewables, and their CO2 emissions didn't go down, and their electricity prices are the highest in Europe. And people just won't tolerate it. It's just that simple. So what it does, though, is these things, as a speculator, that was what creates the opportunity. These false interventions by governments, decree into the markets or whatever, or these falsehoods that are maintained, that's what creates the opportunity for the speculator to enter and take the other side. As George Soros said, a lot of people don't like George Soros. I'm really agnostic towards him. But one of his trading maxims is, find the idea that is wrong and then take the other side of it. So that's what our goal is to do here. So a lot of things going on here in the energy markets. Energy underpins everything that we do, and yet most people have no clue about it, and they take it for granted, which is unfortunate. So that's it for this week, guys. I'll put links to everything here. I suggest you take a look at the links because that's where you're going to get, be able to fill in a little bit more on the information we talk about in these weekly calls or videos. And appreciate everybody supporting me. Keep on listening to our videos, and we'll talk to you next week. Thanks, guys.